welcome back to the channel. In this video, I'll be covering an ETF that pays 10 to 12% in annual dividends using covered call options. I have broken this video into 5 sections. 1. What is QYLD? 2. Why is it attractive for investors who are looking for an income? 3. The structure of this ETF and how exactly does it work? 4. My thoughts about when to buy this ETF. 5. Alternative options. I'll be going over each and every section so you can get a very comprehensive view about this particular investment product. I highly encourage you to do your own research and to check if this is right for you, or speak to a registered financial advisor with regards to your individual circumstance. Now let's get into what is QYLD. QYLD is the Global X Nasdaq 100 covered call ETF. The primary underlying idea is that a person investing in this ETF is giving up the future upside from holding a stock in order to generate income right now. The ETF follows a covered call investment strategy in which the fund buys a stock or basket of stocks and also writes a call option that corresponds to that stock or basket of stocks. I'll be explaining all this in a lot more detail when we go over exactly how this ETF works. The reason this ETF is attractive for those who are looking for an income is because this ETF pays a monthly dividend. So it's a great option for anyone who's looking for a payout that's consistent and monthly. The reason for that is because of how the ETF is structured. QYLD's covered call writing process. QYLD buys all the equities in the Nasdaq 100 index. QYLD then sells the Nasdaq 100 index options to a counterparty that will expire in 1 month. A premium is received in exchange for the sale of the index options. At the end of the month, QYLD seeks to distribute a portion of the income from writing or selling the index option to the ETF shareholders. At the beginning of each new month, this process is then repeated. Writing covered call options is not a very difficult process, but it's great that there's an ETF that you can buy into that will just mechanically do the work for you. Of course, to outsource the work, you will be paying an expense ratio, which in this case is around 0.6% as of this recording, which I feel is quite reasonable. This strategy of collecting income now while foregoing the upside from holding the stock is going to definitely underperform if the underlying index, which is the Nasdaq in this case, continues to rally higher as it has in the past. In my opinion, the time to be investing in QYLD for someone who is looking to generate income from covered calls is when there is an expectation of a stagnant or a slightly downward moving market. Let's go through the graphs presented on their website that illustrate this better. In a down market, the Nasdaq 100 index ended the month lower, so QYLD, which sold the call option, would potentially benefit from the premium received. This may offset some or all of the decline in the underlying equity holdings. In a flat market, if the index price has not changed at the end of the month, QYLD keeps the money it collected from selling the monthly index call, and the fund still owns the underlying equities. In an up market, if the index price rises at the end of the month, potential gain will be limited since the fund sold a call option at a predefined strike price. As the index rises above the strike price, the fund still keeps the money collected from selling the monthly index call option, but won't benefit from the entire increase in the index value. That is why the ideal scenario for QYLD is a flat market where the underlying stocks in the Nasdaq go nowhere or even slightly lower. Investing in QYLD is more of an opportunistic buy than a long-term hold. Also, there is a huge consideration in the form of taxes, which will be different for different people based on where you are located and the kind of payout that you receive from this particular ETF. What I mean by that is that the ETF may also return capital in order to maintain the dividend payments. Return of capital may be exempt from any taxes in a lot of cases, but if the dividend is paid from collecting premiums in the covered calls, then that might be subject to different tax rates depending on the individual investor's background. I will be including a link in the description to the QYLD website so you can go through it for yourself if you are interested in this. The same investment strategy can be applied to other underlying indices. And that is exactly what Global X has done. There is another covered call ETF called QYLD, which uses the S&P 500 as the underlying index, and RYLD, which uses the Russell 2000. All of them are good options, but I would encourage you to check the total assets under management and the liquidity for each of these ETFs, since that might be good factors to consider when investing in these products. Let me know in the comments if you are currently an investor in covered call ETFs, or if you know of any other investment products that are good for monthly dividends. Thanks for taking the time to watch this video, and have a great day.